Welcome, Ravi. Can you hear us? He's joining us all the way from Singapore.
Yes, I can, Charanjit. Good to see you.
Wonderful to see you, Ravi. And the stage is all yours.
Thank you. Thank you, Charanjit. Very good morning to everyone in Tokyo. And welcome to the Japan FinTech Festival 2024. I'm delighted to be joining you, although via video conference from Singapore. Now, Japan has a long tradition of being a technological powerhouse. In the half century since 1945, Japan rose from the ashes of war to become a global leader in the application of technology, with a deep commitment to innovation and excellence. Those of us who grew up in that period will recall Japan's technological prowess across diverse industries like automobiles, consumer electronics, and robotics. Japan continues to thrive in these areas. But in the last 3 decades, it has not been quite at the forefront, say in digital devices and solutions. Particularly in the area of financial technology or FinTech, I think Japan has not fully realized its potential. Prime Minister Fumio Kishida's vision of a new capitalism offers a significant opportunity to kickstart and turbocharge Japan's FinTech sector. It lays out a strategy to reform Japan's financial and capital markets and unleash a virtuous cycle in investments to transform Japan's economy. There is a 400 billion yen commitment to upskilling the workforce. There are plans to scale up investments in critical areas like semiconductors, as well as in key emerging areas like quantum technology, artificial intelligence, and biotechnology, including attracting investments worth 150 trillion yen in green economy initiatives such as hydrogen and renewable energy over 10 years. There's also a 5-year plan to bolster the startup ecosystem, including reforms to increase venture capital funding for innovative startups. The goal is to support the creation of 100,000 startups and 100 unicorns in Japan by 2027. In short, there is great opportunity in Japan for entrepreneurs, startups, and established financial institutions to collaborate and drive FinTech innovation. The FinTech world that Japan will seek to play a key role in has seen dramatic changes over the last 10 years. Let me highlight 4 key trends in global FinTech that I believe have the potential to transform the global economy and financial system. The 4 big trends are: 1, the proliferation of cheaper and faster electronic payments from domestic to cross-border applications. 2, the use of distributed ledgers and tokenization to potentially create a more efficient financial architecture. 3, the application of artificial intelligence, especially generative AI, in financial services. And 4, the growing potential of quantum technologies. Let me start with electronic payments. The global FinTech phenomenon began about 10 years ago, driven primarily by innovation in digital payments. Non-bank players began to offer innovative payment solutions that were cheaper and faster, based on digital wallets and integration with e-commerce platforms. The first phase of payments innovation saw the emergence of national payment systems, enabling 24/7 real-time money transfers at zero cost. Now, these were public payment rails that offered an open, interoperable infrastructure, enabling both banks and non-banks to provide innovative payment services to consumers. Examples include the UK's Faster Payment System in 2008, India's United Payments Interface, UPI, in 2016, Singapore's PayNow in 2017, and Brazil's Pix in 2020. Now, these interoperable payment rails allowed innovation to flourish while ensuring safety and security. While non-banks drove innovation in the front-end user experience, back-end settlements remained securely rooted in the trusted framework of regulated banks. Today, there are about 60 digital payment systems worldwide, with 2/3 of adults able to make or receive digital payments. This has substantially enhanced financial inclusion and business efficiency. The second phase saw the establishment of bilateral linkages between national payment systems. It began with the integration of Singapore's PayNow with Thailand's PromptPay, and subsequently with India's UPI and Malaysia's Do It Now. Now, these linkages have helped migrant workers send money back to their homes at much lower cost and greater speed. We're also seeing a flurry of bilateral QR payment linkages. Example, Thailand, Cambodia, Indonesia, Malaysia, Cambodia, Vietnam. Now, these linkages allow tourists from these countries to make payments at merchant points in the other linked countries. But setting up bilateral payment linkages is time-consuming and resource-intensive. We're thus moving into the third phase, building multilateral real-time payments connectivity. Project Nexus, a collaborative initiative by the Bank for International Settlements Innovation Hub at its Singapore Center, aims to create a multilateral network connecting domestic instant payment systems across different countries. It is an initiative initially among the 5 ASEAN nations of Singapore, Indonesia, Philippines, Malaysia, and Thailand. Following a successful prototype connecting the faster payment systems of the Eurozone, Malaysia, and Singapore, Project Nexus is now on the implementation path to achieve multilateral payment connectivity across the 5 ASEAN countries. Cross-border payments connectivity is also being achieved outside the traditional public rails. For example, we have private sector innovations like Onafric, a pan-African payment system that seamlessly connects 500 million mobile wallets across 40 countries in the continent. Onafric's integrated network of mobile network operators, money transfer operators, and banks has simplified payments and transactions across the continent. What is striking about the evolution of electronic payments over the last 10 years is how so much of it has been pioneered in the global south, and especially here in Asia, and how so much of it has been driven by the imperative of financial inclusion. It has truly been innovation with purpose. The second trend in FinTech, the use of distributed ledgers and tokenization in a quest to create a more efficient global financial architecture. This new ecosystem comprises 3 key components: digital assets, digital money, and digital infrastructure. First, digital assets. The key innovation behind digital assets is tokenization, namely the use of software programs to represent as a digital token the ownership rights over any item of value. Tokenization is potentially as big, if not bigger, an innovation as securitization. It allows high-value financial and real economy assets to be fractionalized and exchanged over interoperable platforms like the internet on a peer-to-peer basis without intermediaries. It also allows atomic settlement or the simultaneous exchange of 2 assets in real time. An obvious and early application of tokenization has been in financial assets. Digital financial assets are proliferating rapidly. JP Morgan's tokenized collateral network uses distributed ledger technology to convert money market shares into digital tokens, which then serve as collaterals for over-the-counter derivative deals. Policy and regulatory impetus to facilitating digital assets is gaining traction. The Monetary Authority of Singapore, along with partners from the financial industry, has launched an initiative called Project Guardian to lay down frameworks and protocols to harness the benefits of tokenized assets. Project Guardian aims to integrate digital assets seamlessly into mainstream financial operations like listing, distribution, trading, settlement, and asset servicing. In its first pilot, DBS Bank, JP Morgan, and SBI Digital Assets Holdings conducted transactions in tokenized foreign exchange and government bonds, including tokenized Japanese yen and tokenized Japanese government bonds. Subsequent pilots have sought to tokenize trade finance and wealth management products. Japan's Financial Services Agency, FSA, is a part of Project Guardian's policymaker group established in 2023, along with Switzerland, Singapore, the United Kingdom, and the IMF. The second component, digital money. Now, digital money enables the payment, clearing, and settlement of digital or tokenized assets simultaneously on the same platform. But like all other money, digital money must have stability of value and security of redemption. There are 4 contenders for digital money: privately issued cryptocurrencies, 2 central bank digital currencies or CBDCs, 3 tokenized bank liabilities, and 4 well-regulated stablecoins. Of the 4, private cryptocurrencies have failed the test of digital money. They have performed poorly as a medium of exchange or store of value beyond that for purposes of pure speculation. CBDCs, tokenized bank liabilities, and well-regulated stablecoins are much more promising as digital money. SWIFT has launched the testing phase of CBDC Interoperability Connector that links the CBDCs of 3 central banks, the Hong Kong Monetary Authority, the National Bank of Kazakhstan, and the Reserve Bank of Australia, and 30 other financial institutions. The objective is to create conditions for the seamless coexistence of new digital currencies with existing fiat-based currencies and payment systems. Citibank is piloting Citi token services for cash management and trade finance for its institutional clients. The trials will integrate tokenized bank deposits and smart contracts into Citi's global network, enabling their clients to transfer liquidity between Citi branches on a 24/7 basis. Amazon and Grab, partnering with Singaporean FinTech StraightSex, the issuer of Sing Dollar stablecoin, have piloted a novel system leveraging purpose-bound money. Now, this technology utilizes a secure digital wrapper to enhance security and trust in online transactions. Functioning similarly to an escrow service, it guarantees that buyers receive their purchases before sellers obtain payment. The third component of the new financial architecture is digital infrastructure. Now, existing digital asset networks in the form of either public permissionless blockchains or private permissioned blockchains, neither of them are fit for purpose as a global infrastructure for digital assets. What we need are open and interoperable digital networks that are compliant with regulatory requirements. In Japan, the corporate sector has taken the lead in developing a blockchain-based consortium of more than 100 members, including Japan's 3 big banks, Mitsubishi UFJ Financial Group, Sumitomo Mitsui Banking Corporation, and Mizuho Financial Group, as well as the telecom group NTT and transport group East Japan Railway. Internationally, the Monetary Authority of Singapore, in collaboration with industry partners like BNY Mellon, DBS Bank, JP Morgan, and MUFG, has initiated a project to serve as a global public good digital infrastructure, through which cross-border transactions and trading of a range of tokenized assets can be done seamlessly. Together, digital assets, digital money, and a foundational digital infrastructure have the potential to realize the vision of seamless financial transactions across the world. The third big trend in fintech that will be of growing importance and impact in the years ahead is artificial intelligence. AI, often misconstrued as a single technology, actually encompasses a diverse range of technological models aimed at replicating human intelligence in various tasks. They're already having applications in fintech. Machine learning models, or MLMs, identify patterns in data sets using computational power and advanced algorithms. Example, Singapore's DBS Bank has a financial planning tool, the NAV Planner. It leverages MLMs to recommend suitable investment products and offer personalized financial advice based on individual customer profiles. Deep learning models, or DLMs, analyze multiple layers of complex data to train sophisticated artificial neural networks. DLMs empower banks to predict customer churn with higher accuracy by analyzing vast amounts of transaction history, demographics, product usage, and customer interactions. Now, this allows banks to focus their retention efforts more effectively. Large language models, or LLMs, process vast amounts of text data to predict human language patterns and create content. For example, Bank of America's Erica, which is an LLM-powered chatbot with over 10 million users, has handled over 100 million client requests, assisting with tasks like balance checks, payments, and credit reports. And of course, generative AI, or Gen AI. It uses various AI technologies to create new content, including text, images, music, and more. LLMs are a specific tool within this toolbox, designed for generating and processing text in a human-like way. For example, Japan's Fujitsu, Hokuriku Bank, and Hokkaido Bank have announced joint trials to explore Gen AI for banking operations. They will leverage Fujitsu's AI platform to automate tasks like responding to internal inquiries, generating and checking documents, and creating software programs. But to safely harness the tremendous potential of AI for the financial sector, we need to address its significant challenges. Let me highlight 3 of them. First, bias and factual errors. AI models trained on incomplete or biased data can generate seemingly plausible but factually incorrect predictions or content. Now, this can lead to flawed financial decisions regarding credit, investments, or in other areas. Second, data privacy concerns. AI's reliance on extensive data raises concerns about customer privacy. Even discarded data can be used to draw unintended inferences, and AI can be misused to facilitate sophisticated scams and phishing attempts by mimicking real human behavior. Third, workforce skills gaps. The rapid evolution of AI technology creates a widening gap in industry readiness. Our workforces often lack the necessary skills to navigate an AI-driven financial landscape, and upskilling efforts might struggle to keep pace. Major jurisdictions are establishing principles and guidelines to mitigate potential downsides of deploying AI in various sectors. The European Union's proposed Artificial Intelligence Act aims to establish harmonized rules while fostering innovation and mitigating risks, especially in high-impact sectors like climate change, healthcare, and finance. It establishes obligations for AI based on its potential risks and the level of impact. Japan's social principles of human-centric AI set out the framework for responsible AI development. Now, these principles encompass human centricity, education, privacy, security, fair competition, fairness, accountability, and transparency, and innovation. Singapore has developed AI Verify, an AI governance testing framework and software toolkit that utilizes 11 AI ethics principles that are aligned with international frameworks. The fourth big trend in FinTech is more nascent: applications of quantum technology. Leveraging on the principles of quantum mechanics, this technology promises to revolutionize various fields through its radically new approaches. Investments in quantum innovation are projected to rise from $80 million in 2022 to $19 billion by 2032. Quantum technology has strong potential applications in financial services. FinTech firms are working on solutions to complex problems like portfolio optimization, derivatives pricing, risk modeling, and fraud detection, using the potential of quantum computing. But quantum computing also poses substantial and perhaps existential cybersecurity risks. The integrity of financial infrastructure, communications, and data is at stake. encryption protocols could be compromised, potentially undermining the fundamental pillars of finance, namely trust and stability. The so-called harvest now, decrypt later approach taken by cyber criminals today highlights the urgency to address these vulnerabilities before they become exploitable by future quantum computers. Embracing quantum technology safely requires a collaborative leap in preparedness. Our ability to adapt and innovate in cryptography will be critical for harnessing the potential of quantum technology without succumbing to its security risks. Japan's Q-Star initiative identifies global use cases in quantum technology, sets out industry roadmaps for a quantum-powered future, and aims to extend the benefits of quantum technology to 10 million people by 2030. Singapore and Japan are collaborating on the NQSN Plus digital connectivity blueprint. This is Southeast Asia's first quantum-safe network infrastructure that aims to standardize quantum key distribution protocol by enabling two parties to produce a shared random secret key for secure encrypted communication. The global fintech wave that began some 10 years ago continues to ascend. While the electronic payments revolution is in its heyday, we are still in early days in tokenization, in AI, and in quantum computing. There is potentially much exciting innovation ahead, not to mention economic benefit and social good. But before I close, I want to highlight a fifth area very briefly where fintech needs to do more. This is in the area of sustainability. The scorching heat of 2023, which affected Japan too, by the way, serves as a stark reminder that climate change is real, the time is running out, and that global collaboration towards sustainability is urgent. A critical area of gap that fintech can potentially help to fill is in climate-related data and disclosure. There are some early efforts though. For example, the Greenprint integrated platform developed by Greenprint AI and supported by the Monetary Authority of Singapore alongside HSBC, KPMG, MUFG, and Microsoft, aims to provide a simplified disclosure reporting tool, customized transition path insights, and a marketplace for sustainability-focused services to help businesses and financial institutions navigate their sustainability journeys. But we need much more progress on this front. And platforms like the Singapore and Japan FinTech festivals play a vital role in fostering cross-border collaboration for FinTech for good. And together, we can navigate the challenges and harness the opportunities of global FinTech and build a more inclusive and sustainable future. Thank you.
Thank you, Ravi. Wow, what you said was so insightful. I'm sure we have so much to talk about and so many questions for you. Unfortunately, I only have time for one question while we still have you on webcam. Now, you spoke about the need for policy frameworks and guidelines to regulate the way that AI and quantum technology is applied in financial services. So do you think there could be a clash, and I guess this is an age-old clash, between policy on one hand and innovation on another?
Yes, thanks, Charanjit. As usual, difficult question. And I would say the clash would be between innovation and security. And policy, I would describe as a means to try to balance those two. How do you promote innovation for social good while managing the risks and ensuring security? And I think this is most stark today in artificial intelligence, less so perhaps in quantum, because I think quantum has not entered mainstream life yet. So thankfully, we have a bit of time, though not a lot. But in the area of AI, it is right there before us. As I mentioned, AI tools are being used to make decisions. Now, we know that there are risks and concerns associated with that use of AI, but we also know that the use of AI has vastly multiplied the benefits It has reduced, it has enabled much more customized solutions. And we all enjoy using Gen AI and other AI tools. It has enabled much better productivity, customer service, and so on. And yet there are concerns about data, there are concerns about hallucinations and the like. And I think policy has to strike that right balance of between the two. And this is, as you correctly pointed out, it's an age-old challenge with all technology. When we invented the internal combustion engine, we gave up the horse-drawn carriage, but we had more road accidents, we had more fatalities. And so we had seat belts, we had traffic lights, we had pedestrian rules, safety features built into cars, education for drivers, driving tests, and all that. We've dramatically brought down those accident rates. Not to zero, so it still remains a challenge. But this is what policies tries to do with every new technology, to understand the risks and to manage those risks in a targeted way without upsetting the broader benefits that the technology yields. I don't think any of us today wants to go back to horse-drawn carriages. And we rather learn to live with the risks and manage the risks and reduce the risks associated with motorized travel. And I think the same will happen for AI as well. It will take some time, some heartache, some mishaps, but I think we'll get there.
Indeed, we are getting there already. Thank you once again, Ravi Menon there, live from Singapore. What inspiring words.
Thank you.